quotes, make sure you look at people in the eyes, and make sure you treat everyone the same. It was kind of like what I learned from him back at the time. He developed some gated communities. That's probably me. If you can see that in the middle photo, that's me. Was probably maybe 2 or 3 years old. He transitioned from commercial shopping centers to then started doing unit blocks. And then towards the end of the GFC, that was the last building he built. And you can see me on the left-hand side. He basically, it took him 6 years to finalize this building. And that was the building that pretty much wiped him out, right? So he pretty much lost 50% of everything he had. It was very tough times, and he pretty much lost it, and he hasn't recovered since then, right? So when I moved to Australia, why did it all fail, right? Because at that point, he admittedly said to me that he was selling everything, and he would be selling the apartments to everyone, and he would be putting a premium on the apartment and the rate per square meter of the next one and the next one, and everyone was buying properties of him. I think at the time he was borrowing money at 20% interest rate, right? And in Colombia, if you think interest rates are high here, where it's 6%, over there they're around 13%, right? So very different market times, very different periods. The economy is obviously very different, but he went broke, right? And it all fell for him. So when I moved to Australia, I made it my mission to understand why that had happened. He was an architect by trade, right? So he was an architect. He did beautiful things. He designed beautiful things. But the financial side of it, understanding the cycles, understanding the framework, understanding the impact of the economy and everything that is happening on his projects, I think was the part that he didn't have. So when I moved to Australia, I did this course. I enrolled into, I studied English, went to university, did property valuations and finance at RMIT, graduated with honors, became a qualified property investment advisor, agent's representative, purely because I had two options. It was either become an architect or try to understand why it had all failed, right? And so I decided to choose this degree, which was valuation-based, investment-based, and that's where it all started. I worked for multiple companies. I worked for a construction company, worked with a developer, and it was great because we were doing great projects, but I couldn't get a good understanding of what was happening and what was to come. So I joined this company, Performance Property, which was probably the one that had the last impact on my career. That's me at ANZ Private Bank. We were presenting to all the private bankers. That's where I met Vishal, because I was presenting for the CBA, for the ANZ staff. And it was James Delop, the Director of Private Banking, and CEOs, and pretty much the ANZ staff. We did that. We did that for Melbourne Bank. We did that for Westpac. And we were managing all the portfolios. And what I started seeing when I was doing that was that they had a way of doing things. Everyone was, the portfolios, I would value yours, and I could see the difference between why is yours generating more wealth than yours, And that was really interesting to be behind the scenes to see what was coming, right? Like, how do you understand that? How do we think about it moving forward? I was traveling Sydney, Adelaide, Brisbane. I was doing all the conventions and stuff, a lot of traveling. That business taught me everything I know about research. It was a research-based business, right? It was purely investment advisory business. I transacted huge numbers with them, over $1 billion worth of properties. We dealt with multiple private clients, managed their portfolios. I ran the national department for buying 7 to 10 properties every single month for 3 years, working late hours. I enjoyed the Melbourne run. When we bought properties in the Melbourne run, we started thinking, okay, what is first in Melbourne coming? But it was probably apartments were probably worth $390,000 at the time, right? Right now, same apartment is probably worth $600,000, right? And they haven't gone up since then. Bought an apartment, bought houses, Faulkner, Taylor's Hill, and we saw how the market was moving. We saw how the market was transitioning from apartments getting too expensive, houses getting too expensive, then townhouses, and then apartments, right? That's how the cycle will go here in Melbourne, and we saw all that. Then we moved to Brisbane, and in Brisbane, as an investment advisory business, we made some mistakes, right? Because the guys I was working for at the time, they made their clients a lot of money buying Art Deco apartments in Double Bay, Ross Bay, Surrey Hills, in Bondi, right? In Sydney at the time, because that's when the cycle started, 2013, 14, around that. And they were very successful buying these Art Deco apartments, right? When they started investing in Melbourne, the same thing. Villa units, Art Deco apartments, Bayside, good returns. What that taught us was that every market was different. There was a driver for every single market. Melbourne, Brisbane, they're all different. Perth is different. The way people live, what people want, because in the market, it's not only about houses and money. It's also about people. It's also about what they want and how they want to live, and where are people going, right? So that taught me a lot about those two markets. I was in Brisbane. I got to know the market very well. We were buying houses in Red Hill, Paddington, Wavell Heights, Windsor, Aspley for $450,000, $500,000. Right now, those properties are $1 million, right? Some of you may have properties here. I'm not going to say who. But then the market went up all the way up there, close to the Sunshine Coast, right? And you see the wave of it moving because the market is driven by humans. And humans, sometimes we act rational, and sometimes we act irrationally. That's normal, that's normal. And we live through cycles. So that's when I decided to create this business, which is called Invescasa, investment, and casa, which means home in Spanish. And that's where the idea came, because I was thinking, I've seen all these people making money. It's great. I've seen what works and what doesn't. But what about connecting me to my roots and what I wanted to do this for myself as well, right? So that's when I started the business. Right now, we're a boutique buyers agency. We don't want to be a big business. We want to be very premium, bespoke service. We want to provide guidance and stewardship to everyone that wants to invest through residential property, and that wants to grow their wealth. Essentially, that's what we want to do. I have acquired a number of properties nationally. We're not real estate agents. I'm not a real estate agent. I don't sell properties. Yeah. When you come to me, I'm not selling you a property. I'm helping you. I'm working on your side. I'm providing advice to what works best for you, right? Based on your situation. I don't take commissions for developers or builders or anything like that. We purely buy established houses, and that's what I'm focusing on, right? That is the model, is the lowest risk model, and that's what we're here for. My framework, which is, I wanted to put this slide here because it's not only the experience that you have in the market or, consistency that gives you the performance of and the understanding of the markets, but it's also how you think about it. So the way I think about property is through business, property, and life cycles. I think about human nature, right, and its rationality, and I think about the monetary rules that pretty much rule us, right, because it's a capitalist world, essentially, right? So our core strategy is, as I said, residential properties. We focus on middle income, growth corridor, where the market is going, areas, right? Close to infrastructure, close to amenities. We want to be in the areas before the developer comes in. We want to get into the market wisely. We want the media to come on. We want everyone to start buying, and we want everyone to drive the market up here, but we want to be the first one coming into here. And to get into here, we need to understand what drives everything. I think the track record, I put this graph in here simply because, I think obviously I've gone through all this process. We've done all these studies of the cycles and going back in history and all that. But through the last 24 months, even COVID, coming out of COVID, a lot of people did nothing. The market went up 25%. Interest rates went up. A lot of people did nothing, and the market still went up 10%, especially in the cities where we're buying, right? So most of our clients, I've got clients here, I'm not going to say who it is, but they've bought 2 or 3 properties with me in the last 2 or 3 years, right? Good properties, blue chip assets, no construction, no apartments, no townhouses, just quality assets, right? Because at the end of the day, what I saw when I was valuing all those portfolios was that you need at least, ideally, you need at least 4 or 5 properties. That's all you need. 4 or 5 good quality assets over the long term Properties will pay for itself. That's what you need. It's essentially a game of doubling your money. How can I double my money through every single cycle? That's what we need to be thinking about. And I'm going to show you some data about that. So this is a house that we bought in Salisbury. We bought it in 2022. Right now, it's gone up 120 grand. This one is in Brisbane. I'm not going to get into the details of it and the yield in the suburb because there's a lot more information about it. But this is the type of product that we're buying, and this is what we are doing. I'm not selling property. I'm selling, the knowledge and the guidance through this process. But the main question of the presentation, that was just examples, just to make it clear. The main question that we should be asking ourselves is, what do I need to be looking at? What do I need to be looking at? Yeah? What do I need to be looking at? And how does an investor generate returns? Yeah? So this graph shows interest rates coming down, right? Last 30 years, interest rates have been coming down. That's a clear graph. We know that that's a fact. Yeah? Can we control interest rates? No, no one knows. But we do for a fact know that interest rates are related to inflation, right? So there's a relationship between the two of them. And right now, interest rates are going up and inflation is going up. So we've had a price growth for the last 30 odd years of all the markets going up in an upward trend. So interest rates have been coming down and property prices have been going up, right? Through that graph, then we can see that there's ups and downs. It's normal. On a long term, holding it long term, we all know that property, it's a hedge against inflation. So property protects your wealth, right? We know that. Now, back here, are we starting a new cycle? In my thesis or my study on how I look at this information is with this particular clock here. So when things are going well and the interest rates are down, people start spending more money, people spend in cafes, spend in shops, everyone's got disposable income, property prices start to go up, everyone's feeling happy about it, right? And then people keep buying more and keep buying more until the music stops, right? And then what happens? Inflation goes up, the RBA, which is the Reserve Bank of Australia, pushes interest rates up to slow down inflation. And what happens after that? Then we go through a slowdown. And the businesses get less money, there's less investment in property. Then we go through a bit of a recession, and then we go back up. That has been happening for the last 200 years, without doubt. Yeah? So there's 4 stages to this cycle. There's 4 stages to it. As an investor, we just have to know at what stage of the cycle the market is at. It's relative, right? Relative to everything, because in Victoria you could have certain suburbs in certain areas that could go up in price. You have apartments, houses, townhouses, outer ring, middle ring. You have north, south, east, west. Very different markets, but we're talking on an average level. We're talking from an investment point of view, right? And we're talking when you're obviously looking at an investment, you're obviously trying to think, how can I grow my assets and how can I generate good returns? Yeah, I can buy a property. But if it's costing me a lot out of my pocket and it's not growing up in value, those are the questions that we need to be asking ourselves. In the last 12 months, all the markets pretty much have recovered, and they're going through. I'm saying recovered, but they're moving up, right? So they're going through that. They're coming out of that sort of recessionary period, and every market is different. We have seen some markets that are moving different to other ones. There's 4 key things I look at. I look at price to income ratios, I look at vacancy rates, I look at the unemployment and the infrastructure, and I look at the return on investment. Those are the 4 things that you need to know when you're trying to figure out where am I going to put my money. The first one is the price to income ratio. You go to a bank and they say how much you spend, yeah, how much you spend on dinner, and then they look at your bank and they'll say, look, based on that, we can lend you X amount, right? So it's all based on income, on the income that you generate. So on average, if the income is 100,000, a house in Sydney is 14 times the average income, right? And banks will lend you money 4 to 7 times your income. So it's already unaffordable, right? Then you go to places like Melbourne, it's 11 times the income, right? Some places I could, get a house for 600 grand, but how far am I going to be? And then you go to Brisbane, Adelaide, and Perth, which again, it's a matter of understanding the cycles. They have lower price to income ratios, those cities, because they're cheaper. They're more affordable. They haven't gone through that growth period. This is a great example of the Sydney property cycle, right? So Sydney median house price was 600 grand, went up to 1.2, and then the interest rates were obviously coming down. So it's a relationship that works like that. Now, if you're an investor and you're thinking interest rates are 2%, am I going to leave my money on a saving deposit? Well, I'm going to get 2%, but if I put it in property, I get 4 on return, on rental, and I get 5 or 6 or 7 on capital growth. So you get 10% growth, 10% return overall. So that's why a lot of people, smart investors, started investing into property. And in that cycle, you have two options, right? Either you're investing to generate cash flow or to generate equity. And that's a question I get asked very often. I got clients that come to me and say, I want cash flow, I want cash flow. And I say, yeah, but you want cash flow, but you also want to build wealth through property, right? Because it will grow faster than you putting $2,000 every month on your bank account, right? And it's obviously because of the leverage as well. So then these are the rental returns. I've made some lines, the blue ones and the red ones, just to show you that the highest yields are right now in Perth, Adelaide and Brisbane. And I'm going to show you an example it's going to help you understand that, because that just looks like numbers right now. Yeah? This is the example that I want to show you. So let's say you have a house in Sydney, right? You bought it for 600 grand in 2014. Right now went up to 1.595, which is the median house price. The growth, 150%, right? So full doubling cycle. The rental yield, when you bought it, was 4.9. Right now, that same rental yield is 2.2. Now, we go back to this graph, rental yields in Sydney, they're 3, right? So the yield is an indication of where the market is in the cycle. If I've got a higher yield, it indicates how much price growth the city has had. So it's a clear example on where the places should be for investment. Then we got Melbourne, similar situation, low yields, the median house price is through the roof. Brisbane, then we got Adelaide and Perth. So whenever we get a period of growth, if you're lucky enough to buy a property, in the growth part of the cycle, typically what follows is 7 to 9 years of growth. Yeah, and you grow your asset, or the asset grows at least 60 to 120%. Roughly, right? Every cycle could be different, We may get more money out of China, India, something may happen that we don't know, but historically, that's a return. Now, if you're unlucky enough to buy at the top of the cycle, typically what follows is 4 to 7 year price contraction. Now, I've got 15% median house price reduction, but the market goes in a recession, people don't leave. You still stay in your house. So maybe the investors that are over leveraged, they're the ones that sell. So certain parts of the market get affected a lot more than other ones. This is right now where we see, this is our view on the market. I think Adelaide is in the buy momentum stage. I think Brisbane is in the hold stage. Brisbane has done 70% growth here. I can show you here. Has done at least 70%, 80% growth, sorry. Adelaide has done 70 at least. And Perth has done 12%. Now, when I say 12% or 80%, it's from the median house price, right? You've got houses, but you've got Red Hill, Paddington, or you've got, up in Ipswich or down south close to Gold Coast, very different markets, right? So on a granular level, and I think I've got obviously some of my investors here, they would know that whenever we're doing this analysis, we're not only looking at the market, but we're also analyzing the suburb. In the last 5 years, how much growth has it had? Because at least we know that if we buy that asset, that's the best probability we have to generate a better return. I don't have a crystal ball. I can't say, oh, your property is going to double. But I think based on history, that's probably, we have a high probability of the same thing repeating. And we know that that's probably the case. Now, moving forward, inflation rates coming down because interest rates went up. So inflation is coming down. Again, the same sort of cycle happening. And the same sort of thing happened in 1994 in the crisis here in Australia, the financial deregulation, when they first inserted the negative gearing with Paul Keating, right? So that was in 1990s, right? Around that time, 10 years after, we had the tech bubble that affected the markets, the rate went up. Then we had the 2008 GFC, the market went up, inflation went up, interest rates went up, and then the cycle restarts. And now we're obviously through the COVID-induced. Now, is it COVID? Is it another cycle? It is happening, right? It is happening, and that's just a reality. Yeah, we don't know. I wish I could tell you, that I know what's going to happen in 10 years and when is it going to happen for a fact. But we focus on buying quality assets. I don't want to go and buy the non-performing assets. I just want to focus on the good ones. Yeah, you want to reduce your ability for mistakes, to make mistakes. Now, unemployment is going up. I'm not sure if you guys have seen. Apparently, well, this shows that. But unemployment is going up. Now, if we go back to the cycle, interest rates go up, the businesses feel the pinch, people, leave their jobs, people spend less, companies make less, they have to fire some people. It's a cycle, and then what happens? Then the economy starts back up again. And right now, I think the good thing moving forward that we have is that there's a correlation between every cycle in history and a new technology coming up. Right? So we had 2008, 2009, we had Facebook, Instagram. How many businesses were built through that, using those platforms? How much the economy expanded, the stock market expanded, and that made people really wealthy, right? Now we've got another boom of another technology coming up, and there's a correlation to that. So in Australia, moving forward, migration has gone back to 500,000 new people. Where are these migrants going to go? Where are all these students that, were coming in requiring instant accommodation? It's a great question. South Australia had really good increase as more than Perth, 12,000 new migrants. But there's people are back, and we have a chronic undersupply of housing today. So there's no houses. There's more people coming. They don't have a place to live, and things are pretty tight right now. So this is where I am at this point in time, and I think about all these every day. When I'm looking at investing, advising someone where to buy, and looking at all this information on a single basis. Now, in summary, buy good assets, buy in the growing stage of the cycle, buy in established areas, buy good assets, not quality, not quantity, but good assets. I think my views on the market, are Australia. I think Australia is a lucky country, very lucky country. I think we're very lucky to be here, very, very lucky. Stability, growth rates, livability, security. The system works. The tax, you're paying tax, yeah, but you can see it on the roads. It works, right? Corruption, I don't know, maybe, I don't know, but it works. Good health system. So I think long term, who's going to benefit out of that is the landowners. The people that own land. I think we're going to become a nation of renters. I think less people are going to be able to afford property, and the people that are landowners, they're the people that are wealthy historically. Kings, emperors and all that. So I think that's where this story is going. Is yes, it's going to become more difficult. Property is more expensive, but if you can't get into the market, if you can buy land, something that you can add value to, I think that's a safe way to go. One thing I did wanted to say is that we do a bit of active management right now because interest rates were at 2%. No one really cared about the rental return. No one. Rent the house. Pays for it, that's it. Now, interest rates are at 6%. I got people calling me, I'm going to sell this property because I can't pay for it. So out of a need, we started managing these assets in a very alternative way, right? In a very different way to try to meet the market in very different ways to try to increase the yield and with the lowest fees on the market. So whenever we go to these markets, we set up a property management platform as well, where we can help these people, these investors manage these properties. They get lower fees, they get more cash flow coming in. We can help them, we can negotiate better for them because we don't have 1,000 properties, we probably have 50, but we manage them very well and we get really good returns. And in turn, they can buy more properties and they can, create more wealth. So why it all fell? I think that's the answer. I think it's just understanding the patterns of what has happened. A lack of a strategy. You got to become very specialized in one area and be really good at it. And have really good asset selection, understand the markets, choose the right market and never act on emotion, but think logically about these investments. That's it. Thank you. Okay, well, sorry if it was too much information. Any questions, anything that you guys, I don't know, easy one, please.
How often the cycles happen? 7-9 years?
Yeah, so historically they've been every 7 to 9 years, and then the contraction goes every 4 to 7 years. Historically, that's what has happened, the growth period. Yeah, the growth period, full cycle, land cycle in property. Business cycles is a lot shorter. because obviously business very different asset classes. So you may have stocks, bonds, gold, but you got property. We're talking about property. It's a lot slower, right? The impact on when the rates go up and down, it takes time. It takes time to build a house, right? You said you want to build a project, it takes 2, 3, or 4 or 5 years. So the cycles are a lot bigger. A full land cycle is 18 years, but the actual growth period is about 7 to 8 years. I can send you some graphs on it and a great book as well that you can read on it.
Thank you.
Negative gearing compared to positive?
It depends. I think negative gearing is not a strategy. I don't think it should be a strategy. It's a tax benefit that you get for buying property. It helps investors, right? Because if negative gearing wasn't on the market right now, a lot of investors would sell. And so where are you going to get houses from? You know, how are you going to rent houses? So you invest in property with a strategy in place with the goal of how can I double my money? How can I buy good quality assets? But then also you have to understand your finances as well, right? And typically the assets that are negatively geared are the high growth assets, are the assets, Richmond, South Yarra, Paran, all those assets, they've gone up in value substantially, but they're not cash flow positive, right? So there's different strategies. Your strategy should be either growth strategy or cash flow strategy. Now, cash flow strategy should be for someone that's maybe getting close to retirement and needs a little bit more income, right? We could find some balanced assets where you can still, grow your wealth through this investment. But essentially, if you from 35 to 55 is where the bank is lending you money. The 25, sorry, let's say 20. 20 to 55 is when you have the bank lending you money. So then if you have 10-year cycles, then you have 2 or 3 cycles to enjoy, right? So then you got to be able to make the right decision that at the beginning you maybe build your asset base and get good quality assets, get good equity, and then eventually you start sort of adding different assets to your portfolio to make it more balanced, I think, yeah. Any questions, Vishal?
Francisco, can you bring us back to that graph with the different cities and where they're at with the current cycle?
Sure. That one.
So should we go and buy in Perth? We're all going to Perth. That's the best.
I have a question about that. Since that depends heavily in mining.
Yeah, correct. So the mining boom in Perth went bust in 2012-13. For 10 years, there was no growth in Perth. But right now, we've got a lot of migration coming up. We've got a lot more infrastructure projects coming. It's still heavily reliant on mining. It's a heavily reliant mining town. So I think from the risk perspective, I think it's a high-risk market. When I'm looking at the choice between Adelaide, Brisbane or Perth, the lowest risk would be Brisbane because it's already had some growth. Then middle risk would be Adelaide because it's already gone through 40-50. Perth has got 10%, right? You could buy it. If you buy a good asset, you get good rental income because at the end of the day, the only thing you control is the cash flow. That's the only thing you control. You don't control growth. Growth is, but the only thing you control is cash flow. So if you're still buying an asset in Perth that is, it's got the right fundamentals, it's in a good area, you can get the rental income, and you know that you're buying in a good area, and that you can, if you call your tenants next year, you're going to say, I'm going to push the rent $50 a week. You can still do it. You'll do well through that period, right? But if we look at history and go, okay, interest rates will come back down, then we know that market has a lot of potential. The other thing that I want to say that me as a buyer's agent or investment advisor in this space is we buy these properties and we bring a lot of noise to these properties, right? We went to Adelaide. Then the market starts talking about Adelaide. Then we go to Perth. Now, where's the best market now? Everyone is talking about Perth. So is that same mentality that I said, that you're getting wisely here and then you wait for everyone to push up the asset price, right? So that's essentially what happens. But yeah, there's a bit of a risk that, the asset market will be, the Perth market will, stagnate. Yeah.
Okay, you are talking about Perth is because as well as about, you mentioned about migration. So people come here, so this group, of course, growing. So Perth is one of the
Yeah, correct. It's growth. If you're an investor, where are you gonna, where are you gonna grow your wealth? And you don't want to buy any asset. You want to buy an asset for cheaper, for less than what it's worth. So if I go to Perth and I go 600-700 square meters of land, same house here in Melbourne is 3 million. Same house that is 400 grand. How much does it cost me to rebuild it? you know, the replacement cost is probably higher. To build another one is probably higher than what it's worth right now. So you're buying an asset below replacement cost in those markets, I think.
What is the median price in Perth?
Perth is like 800,000, 700,000, yeah. But Perth is very big market, 1.8 million people, you know, bigger market than South Australia is 1.2 million people. But Perth is growing a lot through the south, right? Because of the lifestyle, the amenities that has down south. And you can buy properties for 400 to 600,000 in Perth as well. But again, it comes back to, you know, managing your risk. You know, you don't want to be a risk taker. You know, you want to be a risk adverse person. You want to grow it slowly, but surely. You don't want to, you know, take a lot of risk, especially if it is your first investment that you're trying to buy. You know.
I have another question about the cycle. So we are close to the peak of the cycle, or do you reckon this is gonna be 3-4 more years to go? And then, sorry, guys, the follow-up that question is what happened after?
I'll ask Vishal about a question about the rates, because everything comes back to the interest rate, right? So I don't work for a bank, but he may have better insights. Yeah.
If you look physically, like basically what's going on from the last 5-7 years, rates have, I remember back in 2010 when I started my home loan, rates were like 7.1%. So people were under the impression rates going to go up. So it basically started to go down. I remember fixing my loan first year 7.1 for 3 years. Next year was 5%. So to be honest, even as bankers, sometimes you can't break. But what's really important is we are at the peak, no doubt for sure. Maybe one more rate rise, I don't think so. But some people are waiting. I mean, when they speak to Fran or myself is, I'm going to buy the rates are lower. The reality is, even if it goes down, it's like 1% only. So if you guys are sitting at 6.5, maybe 1%. But look at Australia, what we are projecting, like I work for Commonwealth Bank, our economists know rates going to be around 5.5%, I would say. So, I mean, when you are buying a property, again, people talk about negative gearing and all, it's all about the financial situation. Negative gearing is nothing, it benefits people who are on a good income. Someone who's on 80, 90K, talking about negative gearing, not going to benefit much. Someone, again, it's all got to do with the tax bracket. Sometimes when they talk to me, I recommend them. Basically, I give them sort of personal advice after checking with their accountant. Husband's on 200,000, wife's on 70. I talk about ownership, what percentage they should have, like a husband like 80%, wife 20%, or sometimes buying a property under trust. So I think these are the things that's really important when buying a property, rather than rates and all. Rates, it's just a cycle. You know, what Fran explained it really well, it can go up and down. But I think even at the time when rates were like 2 or 3%, I was still telling my clients, just be mindful that if rate goes by 6%, because that's just only a matter of time. I need really prepare for the repayment. So having that savings and all is really, really important. That's what investing is all about. I think the right setup and all. Growth and area is important, but again, these are the things, we work together really well, and you always ask me, that's the customer situation or all that. So look, I think he should stop at 650, 700,000. Sometimes people are stretching a lot, and then they later on come back to me and say, I need to sell. Yeah. But I can answer to your question. We are almost at the peak.
Yep, I think the same, because we follow. I probably should. I mean, we follow the US, right? Australia. All the money that we get here from the banks, it comes from the US, right? So we follow them very well. Probably 6 months behind. And so I think, and I know this because I went to multiple conferences, right? When throughout my career, and there was a person that told me that we follow the US. Every time during the day when I'm working, I've got Bloomberg right on my portal, and I've got the news, and we see that over there things are there's the new election coming, right? There's a lot of factors. It's pretty hard to be in the market because there's a lot of things that we have to juggle. But we got a new election coming up. We got things that are happening, and we've got the markets already quantifying at rates going down in the next quarter. But then again, it's like if that's happening, a lot of the people that should have taken a position on something, they've already done it. When that happens, you're going to have 50 more people competing for one house. They're going to push up the price. It's going to become a lot more difficult, right? So it's all a matter of thinking about that that sort of example that I made about getting in. Yeah.
I have a question, so I don't want to...
Yeah.
No, we talk about the cycle of the interest rate.
Yep.
In my take, I think it's going to stay there for a while. I think it's my imagine, but it's...
I think it comes down to inflation, because the Reserve Bank of Australia, their mandate is 2 or 3% inflation, right? And full employment. Employment is going up again, right? Inflation is coming down. It's still not at 2 or 3%. So, whether there's still a bit of a lag because everything takes time to show, could be, but generally it's 2 or 3%. That's where they want to keep it now. Every cycle is bigger than the other one. Whether they readjusted, they've been talking about readjusting that 2 or 3% rate. We don't really know, but we know that there's indicators like the unemployment that it's going up. So if it starts going up, they don't have a choice to cut them. So people can, companies can hire more and so on.
So the growth cycle is still going again for a few years.
So look, the growth cycle here in Adelaide or Adelaide and Perth went up 10% despite the interest rate rises here. So this is 12 months to January. So Perth 10%, 10.7, 16, sorry, and Adelaide 10%. 12 months despite the interest rates went down. Now this is obviously numbers. Now, if you sell your property, like we've got some clients. Obviously, if you're going to sell your property, you're going to sell it in a hot market, put it at auction, right? So these are all indications of where the market is. But I think that is a great indication of affordability. Is because the market is affordable. That's why it rises, and investors just go there and invest more. Yeah.
Francis, a question. Why people are investing in gold at the moment? Why people are talking about gold?
I think it's affordability. It comes down to affordability. I think the market has shifted from Melbourne, Sydney, Brisbane. It's too expensive. People can't afford them, right? If you go to a bank, average investor used to have 600,000 to 800,000. Now they've got 400 to 600. Right, so it's affordability, and money moves in waves. Right, money is just a wave. Right, it's liquidity. It's just it finds a spot, it gets a return, and it moves to the other one, and it keeps going. Right, and so that's why with these sort of investments that we make, it's long-term investing, because we go through those cycles, and that's how you write it up. But I think Perth is because it's affordability. And it's very hot. Like, I'm buying properties there, and they miss out. It goes Wednesday on the market, Wednesday, Thursday, Friday, Saturday. We have a look at it, and Sunday is sold, and it goes back up. And there's some properties that are selling for way higher than what I see comparables. But because they're in good locations, I think they're still going through. So I think it's money. A lot of money from Sydney, a lot of money from Melbourne. If you're a Melbourne buyer and you say 400 grand for 600 square meters of land, close to 2Ks from the beach. 400, 500, 600, you cannot buy those properties here. So I think that's, and obviously the migration is improving as well there. Yeah.
So where would you say there's a good place to buy now?
I think it depends on what.
500K.
Yeah, I think it depends on your goals and your strategy. But there's options. I think it depends. Like what you want to get. We can have a chat later. Book a meeting. I'll send you the link.
I have just one more question. The last one for sure. You know what happened in 2008?
Yeah.
In theory, it's supposed to happen every 18.6 years. So
yeah, the cycle. Yeah.
We expect to have something like that in 2026.
Yeah, great question. I think it's a responsibility. It's a responsibility. It's your ability to respond and have that ability, right? Right now we've got a lot more technology and a lot more data to be able to respond. So back in the 1930s, 1950s, and 1970s, internet, newspaper, it was like that. Now there's a lot more technology involved in it. So I think the government has faster ways of responding. So I think we could have gone through a bit of a mild recession, not on a GDP level, but maybe on a per capita level, right? Because some people were fine, they didn't even feel it. Some other ones felt it, right? So there's a bigger disparity. So I think the cycles may be a little bit shorter, right? Quantitative easing, people pump, the government's pumping money into the economy, and what do? They put the debt down, they write it off, and then go back up and start again. So it's a matter of understanding that game, I guess. And you know a lot about this because we talk about a lot in our catch-ups. What do you think?
No, I completely agree with that. I mean, there's the modern monetary theory where the governments have infinite debt. So which is, and now, you know, with all this data, etc., and different ways in which you can disperse that debt, there is a lot more control that governments have. I actually found there was one slide there, Fran, that we were talking about where there is an overlap of a correlation between, you know, cycles and industrial revolution.
Yep.
And with that
one.
Yeah, this one, for example, right? So we are obviously seeing a cycle come down, I suppose, a downturn starting to emerge. And we showed that, I suppose, the circle with different parts of Australia and obviously Perth, what we discussed.
Yep.
Is there a particular, through the analysis that you've done, is there an area that is emerging? It doesn't necessarily need to be a city, but any part of Australia where one of these, I suppose,
Yeah, great question.
renewable energy is a good one.
So I think about what people are looking for today. They probably don't want to live in apartments. They probably want to live in houses. Everyone's working from home, so everyone needs more space. The remote economy, right? Everyone can be done on Zoom. So there's a need for lifestyle locations. There's a need for, maybe that's why Perth is going up, because, you know, you can buy a house down there, you can live there. You got 3 or 4 bedroom houses. But the places that I see are those ones, just the lifestyle locations. I think they're the ones that are in the big houses. Like we were buying 3 beds, 1 bath. Now I only buy 4 beds, 2 bath. That's the only thing I buy, right? In 3 beds, 1 bath, great for a family. But the family, the way they're thinking about their lives and they need more space is transitioning. So everything has to go through a transition. So I think with this new wave, and I think this graph, I put it down, and I didn't talk about it much, but I think everything comes down to efficiency and productivity. Like incomes, people are, the one that doesn't want to make any money, that it's not going to make money, but if you become more productive and more efficient, that's how you make more money, and then you will, you know, and then you use technology, that's how you're going to create more income, to be able to invest in property and do that. And there'll be a segment of the market, you're all in technology, yeah, so you guys are pretty smart. So yeah, but I think that's my view on it. And I think my view, comes from, you know, books and experience and conferences and speaking to people like yourself, that you think about a lot of what is to come. But I think lifestyle locations is correct.
What about like regional Victoria and rooming houses?
Yeah, regional Victoria. I think regional Victoria had a good run. I think Geelong has done fairly well. It's gone up.
It is, but look now, all the organizations have started 50% work, and it's projected that in 6 months' time it's going to be 80%. So if you look at suburbs like, I will say more about Mornington Peninsula, they've grown by 30%.
Yep.
But what we are noticing in the last 6 months, if you agree, or I don't know, it's 15% lower. So it's not 30% anymore. So it started to go down. And that's again, sometimes people just follow the trend. And it was not realistic that, okay, all the coastal area is going to grow by 20-30% in long term. It was growing. Mornington Peninsula has done amazing, but now it's starting to slow down. Because the reality is organization people will be going back to
Correct. Goes back in, yeah, correct.
So regional was great, 6 months, 8 months back, but again be mindful that it's not going to be growing as much what it was growing, 6 months or a year back. And after COVID, it was absolutely amazing. I know, I've done loans for people who bought in Geelong, 650,000 properties. Now when you're valuing it, when they're buying the property, it's like 859. So Geelong is done absolutely amazing, no doubt.
Yeah, it comes back to, what you want, what you want to do, what's your budget, where you feel comfortable. It comes back to that. Everyone's different, everyone's different. Yeah. Last one.
So when they're looking to buy property, they're deciding between whether they want the cash flow or they're looking for the long-term growth, the capital growth. In Melbourne, what are you seeing as a good balance of both of those at the moment? It's not off the plan that is this or like either Australia. What are you seeing that's actually performing well to the best mix of the markets?
Yeah, it's a good question. If we're talking average sort of purchase price, yeah, look, I think you unique assets, that have a scarcity, because they don't make any more of those. Well-located ones, that you can rent well. You can still, like we had a look at some units in Essendon and Fitzroy, and they're very unique assets, good quality. They're not the typical sort of, development stock that you get. And they'll generate good returns. And that could be a good option for someone that's just, wants to buy here in Melbourne. Yeah, but it comes down to, Georgie, what your strategy is. Are you just purely an investor, or you just want to, build a little bit of wealth, and understanding that and what you're comfortable with. Even if you want to buy here, I've got someone that wants to buy here, well, let's just do the due diligence, right? Want to buy in that apartment, and the flammable cladding issues in all the apartments. So let's just make sure we either pay a really good price for it, and then you get good rental, and then you do all your due diligence on it, so that you can get at least the best of what you can get here. Yeah. All right, that's it. Thank you. All right, that's it. See, guys. I'm going to put this back. I need a drink, yeah?